You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you are doing well on this Thursday. Today, we are going to look at made-for-you solutions in the form of an ETF. If you would like to get exposed to the US market, invest in dividend growers, but you want to keep everything in Canadian dollar. And I get that. It's a pain to transfer everything from Canadian dollar to US dollars. On top of that, you may have the feeling that you're losing money because you have to pay a fee for the conversion. And on top of this, the US dollar is worth a lot more. Sorry, that was hard to get on my mouth. Is worth a lot more than the Canadian dollar. So thinking about all of this, you may just be thinking, well, I want to get exposure to the US market and I want to invest in dividend growers, but I could possibly buy an ETF that does that and trades in Canadian dollars, which kind of makes sense, right? The main advantage of investing in the US market, in my opinion, you have two. The first one, diversification. That is super obvious because there are plenty of companies on the US side that have no equivalent on the Canadian one. I mean, if you want to buy a large retailer such as Walmart, Target, or Costco, if you look at the Canadian market, you'll have to end up with Canadian Tire. I mean, not exactly worldwide exposure such as Walmart, right? So it's pretty tough to find equivalent. If you are looking for international companies like Coca-Cola, Pepsi, or Procter & Gamble, it's impossible to find those in Canada as well. We don't have large consumer products being sold across the world like this. If you're looking for healthcare, same thing. Very difficult to find dividend growers in the healthcare sector in Canada. And most obviously, the technology sector, it's very thin in Canada as opposed to the US where you have multiple choices. But again, investing in the US could be intimidating, so I get the idea. The second reason why you should have exposure to the US market is, of course, historical performance. Yet, historical performance is not a guarantee of the future, and it's not because the US market has constantly outperformed the Canadian market that it's going to be the case in the next 5, 10, 25 years. But you kind of get a pretty good hint that if historically that happened, the fact that the US market has more money, more technology, more diversification, it kind of helped to outperform other types of markets. So it sounds like a pretty solid rationale to invest a portion of your portfolio. Personally, I'm at roughly 50-55% of my portfolio exposed to the US market. Not saying it's an ideal metric, an ideal proportion. On my side, I just see that as I want to have a portfolio that is 50-50, and I must admit, most of the time I have to sell some of my US shares to get back into the Canadian market because I'm outperforming, and sometimes I even go up to 60% US, 40% Canada. So here's the solution now. How about investing in a made-for-you dividend growth ETF such as the CI Wisdom Tree US Dividend Grower ETF? So focusing on quality dividend grower on the US market. The ticker is DGR.B.TO, so DGR.B.TO. Pretty interesting one, mostly because it's been around for a while. So it was created in 2016. So you almost have 10 years of history, which is great because many ETFs are are relatively new. So it's hard to see the performance. And this is one thing that I love when you can find those older ETFs. Problem now is the first one, you have to pay a expense ratio of about 0.38%, which, I mean, to keep things simple could be acceptable, but I find it kind of expensive to pay almost half a percentage point to get exposure to the US market, as it's not that complicated today, right? So when I look at an ETF, I like to look at the overall perspective. I like to look at the MERs, and I like to see the performance over a long period of time. Then I quickly jump to see the top holdings. Because once I know the allocation, the strategy, and the performance over a long period of time, I want to know how this ETF has been made of, like what it has been made of. And again, I was a bit disappointed, not by the quality of those stocks, because actually I own a lot of them, and all the others, I have them in high esteem and could potentially buy those. But what I was a bit disappointed is, while thinking that you have to pay 0.38% in management fees, where the ETF is buying Apple, Microsoft, Broadcom, AbbVie, Nvidia, J&J, Procter & Gamble, Home Depot, Coca-Cola, Pepsi-Cola. I mean, if you're a member at DSR, you probably have all those names in your portfolio. Those are like commonly reviewed, commonly liked companies at DSR. So my point is more, well, how about you build your own portfolio instead of buying an ETF and paying fees for nothing? I mean, it's not the end of the world, but I mean, it's still some money. And the other point that is important here is DGI.B.TO must pay the withholding tax on those dividends. Of course, this one's not that bad because it's like only 1% yield, but because it is operating in Canada, and even if it's in a TFSA, not in TFSA, but even if you have it in a retirement account, such as an RRSP, the company will have to pay the withholding tax because it's based in Canada and they're not investing in CIRSP. You are putting that into the RSP. So you have the 15% withholding tax rate on it, and the results overall, I mean, it matched the S&P 500 since inception. So good strategy, good performance, nothing to say against that. My biggest problem, withholding tax plus the management fee, combined together makes those type of investment not as attractive as I wish they were. And I think that the solution, the counterpart in investing is a lot better, a lot easier. If you're looking actually to get a good start to find great companies on the US market with strong dividend triangle, so companies increasing their sales, increasing their profit, and increasing their dividend, which is pretty much kind of like the businesses that every investors want to have in their portfolio, right? Because those are great companies with growth vectors, with healthy balance sheet that is able to go through a recession and still continue to thrive going on. Well, I would suggest that you start your research with the DSR Rockstar list. So the Rockstar list has been created from the DSR stock screener. DSR members have access to all the metrics so they can actually use the Rockstar list and modify it, which is even better. But for you guys, if you want it for free, that's all right. You can go to moosemarkets.com/rockstars, moosemarkets.com/rockstars. And by putting your email in the form, you will receive an email with the Rockstar list, the most updated Rockstar list. And every month, you're going to receive a new one updated with all the fresh metrics directly in your inbox. Pretty cool, right? So moosemarkets.com/rockstars. And if you're a DSR member, because I know that I have a lot of DSR member listeners, if you go to the DSR fundamentals, you will find the DSR preset and filters. You'll see how to build your own Rockstar screener and potentially adjust it to your liking, and then save that research for later on so you can pull it out whenever you want with all the metrics you have. But if you want a free version, that's all good. moosemarkets.com/rockstars. It's going to help you a lot to narrow down the number of choice of companies to analyze. Then you can narrow it down by sectors because you don't want to buy more of what you already have, right? So you select great companies with great dividend triangle, you filter down by sectors, and after that, you will be able to narrow down your choices maybe to 3-4 companies. Then you can do a little bit more due diligence, read about the business model and making sure it's a great fit for your portfolio and for your strategy, and off you go. So putting a little bit more time into your strategy could be a good way to avoid fees and paying withholding taxes and all of that, as opposed to just investing in a ETF such as the CI Wisdom Tree US Quality Dividend Grower. All right, Moose, that's enough for today. Tomorrow, it's Business Friday. We're going to talk about how you can use reverse engineering to build a better business. Until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.